let's try a little thought experiment. Imagine it's 2025 and you have to start investing from zero. No savings, no experience, just a clean slate. What would you do? Most people would probably wait. They'd wait for the perfect time to get started. But right now, out in the real world, the exact opposite is happening. Everyone seems to be jumping all in. Investor optimism is soaring, the headlines are glowing, and it feels like there's this massive party going on, and you're the only one not invited.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
So that brings us to the big question, right? When everyone else is this confident, what's the right move for you? Do you jump in head first, hoping to ride the wave? Do you stay on the sidelines, paralyzed by the fear of getting it wrong? Or is there a third, smarter path? Well, today, we're going to break down exactly why this happens, what it means for you, and how the smartest investors respond differently, not with more adrenaline, but with a clear, disciplined plan. Stick with me because this might completely change the way you think about timing the market. All right, let's dive right in. Before we can figure out how to react, we first have to understand the psychology that's pulling all the strings. We're talking about something I call the run-it-hot mentality. This is the engine that drives that feeling of market euphoria, that urgent, nagging sense that you have to get in right now or you'll be left behind. So what exactly is this run-it-hot mentality? Think about it like this. You're driving a car and the engine is already revving really high. The smart thing to do would be to ease off the gas, right? But instead, you see everyone else speeding past you, so you slam your foot on the accelerator. That's the run-it-hot mentality. It's when investors stop asking why prices are going up and just get consumed by the fear of missing out. FOMO takes the wheel. It's a purely emotional reaction, not a strategic one. It's all adrenaline, no brakes. And what's so wild about this is it's not new. Not even close. This isn't the first time the market has felt this way, and it for sure won't be the last. It's like a movie we've all seen before. We saw this exact same euphoria during the dot-com boom of the late 90s. Remember that? When any company with a .com in its name was suddenly worth billions. We saw it again in the post-pandemic surge of 2021. And each time the story was, oh, but this time it's different. But the underlying human psychology, it was exactly the same. Now this brings us to a really crucial point, and I want to be clear here. The crowd isn't always wrong. I mean, if the market is going up, it's going up. The problem isn't the direction, it's the timing. By the time market hype goes totally mainstream, when your uncle who knows nothing about finance starts giving you hot stock tips at the family barbecue, the biggest opportunities, the easy money, well, that's often already in the rearview mirror. The risk is quietly flipped from the risk of missing out to the risk of buying in at the absolute peak. So, how do you navigate all this? Well, this quote just nails it. A smart investor doesn't get swept up in the noise of the crowd. Instead, they learn to read it. They see all that widespread excitement not as a sign to jump in, but as a different kind of signal entirely. It's a signal to check their own plan, to double down on their own discipline, and to avoid getting distracted by all the hype. It's a reminder to stay grounded when everyone else seems to be floating away. And this really gets us to the heart of the matter. It's about two fundamentally different ways of thinking, two different approaches to investing. On one side, you have the emotional, reactive investor, let's call him the crowd. And on the other, you have the proactive, disciplined one, the calm investor. Because what truly separates them isn't some magic ability to time the market, it's simply having a plan. This slide breaks the down difference perfectly. Let's look at the left column, the crowd. They're momentum chasers. When a stock is hot, they buy. When the news turns scary, they sell. Their decisions are almost entirely driven by what's happening outside of them. Headlines, emotions, and especially that powerful feeling of FOMO. Now look at the right, the calm investor. Their actions aren't dictated by the news of the day. They have a predetermined plan and they stick to it. They focus on things like their asset allocation and their personal goals. Their driving force isn't emotion. It's pure, boring, beautiful discipline. I absolutely love this car analogy because it makes the concept so clear. In a euphoric market, it feels like everyone is just flooring the gas pedal, trying to go as fast as they possibly can. But the calm, smart investor, they take a moment to just check the brakes. And what are the brakes in investing? Well, that's your risk management. That's the stuff that keeps you from flying off the road when that inevitable sharp turn finally appears. So what does checking the brakes actually look like in practice? It's about having this toolkit ready to go. It means having clear allocation targets, like say you've decided on a 70% stocks and 30% bonds mix. It means diversification, so you're not putting all your eggs in one basket. You could use a simple balanced fund for this, or something like the Classic 3 Fund Portfolio, which is just a mix of US stocks, international stocks, and bonds. Super simple, but incredibly effective. And finally, it means being honest with yourself about how much risk you can handle and always keeping a long-term perspective. These are the tools that build a portfolio that can handle any kind of weather. Okay, so we get the mindset, we've got our toolkit, now let's get really practical. In this section, we're going to talk about the specific, actionable steps a disciplined investor takes when the market feels like one giant party and everyone is screaming, buy, buy, buy. This is where discipline beats adrenaline, every single time. This might be the most important and the most counterintuitive idea in this entire explainer. When everyone is getting more and more excited, piling into the assets that are soaring, the best investors are quietly, almost secretly doing the opposite. No, they're not panic selling, they're rebalancing. They are trimming their winners. I know it feels completely wrong, but this is the absolute core of disciplined risk management. So how does rebalancing work? It's really just simple math. It takes all the emotion out of it. Let's walk through it. Step 1, you look at your original plan. Let's stick with that 70% stocks, 30% bonds target. Step 2, after a huge stock market rally, you log into your account and see what's what. Because your stocks have grown so much, maybe they now make up 85% of your portfolio. You're now taking way more risk than you originally planned for. So, step 3 is where the magic happens. You sell just enough of those stocks to get back down to your 70% target. And you take that cash and you move it into the part of your portfolio that lagged, in this case, bonds, bringing them back up to 30%. You are systematically selling high and buying low without ever needing a crystal ball to predict the future. Okay, but what if you're still in the phase of building your wealth? What if you're adding new money to your accounts every month? This is where another incredibly powerful tool comes into play: dollar cost averaging, or DCA. This is the ultimate discipline enforcer. It's so simple. You just invest a set amount of money, say $200 every single month on the same day, no matter what the market is doing. When prices are high, your $200 buys fewer shares. When prices are low, it buys more. It completely removes the emotion and the guesswork of trying to time your buys, and it forces you to be consistent when everyone else is being erratic. This quote just perfectly sums up this whole section. Rebalancing and dollar cost averaging, they aren't about stopping or trying to miss out on gains, not at all. They're about slowing down just enough to make sure you stay in control of your car. That feeling of euphoria is powerful, but it's also the precise moment when your discipline matters most. Control, not speed, is what gets you to your destination safely in the long run. So, as we start to bring all of this together, what's the one big lesson we should take away from all this? If you forget everything else we talked about today, I want you to remember this. The real key to long-term investing success isn't about chasing the most exciting moments. It's about cultivating patience. This is the core principle right here. Excitement is fleeting. It's temporary. It comes from chasing short-term trends and reacting to scary headlines. But patience is durable. It comes from having a long-term plan and actually trusting that plan to work. Market cycles are going to come and go, hot stocks will rise and they will fade. But the fundamental principle of patient, disciplined investing, that doesn't change. If everyone around you is all in and running on pure adrenaline, maybe the best move you can make is to just step back, take a deep breath, and remember your plan. So here it is, your final simple checklist for long-term success. Number 1, start with a clear asset allocation that actually matches your personal goals and your tolerance for risk. Second, automate your contributions using dollar cost averaging to build that unbreakable habit of consistency. Third, rebalance your portfolio when you need to, maybe once or twice a year is plenty, just to stay in control of your risk. And finally, the hardest part of all, let time do the heavy lifting. Just get out of the way and let your investments compound quietly in your favor. And that brings us to our final thought. So much of the anxiety and stress around investing comes from this feeling that you have to be first, that you have to pick the next big thing before anyone else even knows about it. But the truth is, you don't. You really don't. You just have to be consistent. The smartest investors don't chase fleeting moments, they build lasting momentum over years and decades. And that is the real secret. Building wealth isn't about following the crowd, it's about following a plan. The best investors don't rush into what's hot, they stay steady with what's real. If you can stay consistent, patient, and diversified, time will always be your greatest ally. If this explainer helped you understand how to think differently when everyone else is chasing trends, please like it, subscribe, and share it with someone who needs a reminder to invest smarter.
Here at Invest Education Hub, we turn financial complexity into clarity, one smart decision at a time.